If you enjoy this type of content, subscribe to the channel and leave a like to be part of the community. Now let's get started.
In a matter of days, gold plummeted. It wasn't a timid drop, the kind that shows up in the fine print of an economic newspaper. It was a fall that made veteran traders stop in the middle of the trading session, look at the screen, and think, this doesn't make sense. In a single week, the precious metal recorded its worst performance in years. Billions of dollars evaporated from the portfolios of those who were betting on the asset considered, for centuries, the most reliable in the world. And now comes the part that few are saying out loud. This may be exactly the moment to buy. Before explaining why, it's necessary to understand what is happening on the global stage. Because gold's drop didn't happen in a vacuum. It happened in a specific context, with an internal logic that has repeated itself before. And when you understand this logic, you will look at this week in a completely different way. The world is going through one of those periods in which geopolitical tension and economic instability walk side by side. Trade wars, public debt at historic levels, central banks navigating between controlling inflation and avoiding recession. It is in this scenario that the dollar, almost reflexively, tends to strengthen. And when the dollar rises, gold, which is priced in dollars, falls. It has always been this way. What most people don't know is what comes after this movement. There is a sequence of events that repeats itself with unsettling regularity throughout modern economic history. It is not a conspiracy theory. It is not guesswork. It is data. It is record. It is the kind of thing anyone can verify by consulting financial archives from the past 100 years. And this sequence has a very particular characteristic. It always seems unlikely at the moment it begins, and inevitable when it is already over. In 1918, right after the end of World War I, there was a widespread sense of relief. European economies, exhausted by the conflict, seemed ready to recover. Those who had money saved in banks believed the worst had passed. 8 years later, the savings of millions of people had lost 80% of their real purchasing power. The French franc, the British pound, the German mark, all were silently destroyed by the inflation that followed in the wake of war debt. Those who held physical gold went through that period practically intact. After World War II, in 1945, the same pattern. The United Kingdom emerged victorious. The empire still existed on paper, and British government bonds seemed like the safest investment on the planet. What happened to those who trusted them over the following decades is already known. The pound lost more than 80% of its real value. Gold, again, preserved wealth. In the 2000s, after September 11th, the dollar was treated as the most solid asset in the world. The United States responded to the attack with military strength and financial confidence. Between 2001 and 2008, while the dollar consistently lost strength, gold multiplied its value several times. 3 distinct historical moments, 3 different geographies, 1 single result. And now, in 2026, gold has just fallen in the most intense week of the past years, precisely when global conditions disturbingly resemble those 3 moments. The question that needs to be asked is not, why did gold fall? This answer is simple. Capital fleeing to the dollar, liquidity being sought in times of tension, a technical correction in a market that had risen a lot. All of this is reasonable and explainable. The real question is, what happens next? And to answer this seriously, it is necessary to understand something that economics books rarely teach directly, a silent mechanism through which governments transfer wealth from ordinary people to the system, without anyone needing to sign anything, without any law being openly passed, without anyone being formally blamed. This mechanism has a name. It has a history, and it is fully in operation right now. If you're following this content and want to understand how this system really works and what to do with this information, don't forget to subscribe to the channel, like the video, and tell us in the comments which city or country you are watching from. This helps the channel a lot to continue bringing this type of analysis. The mechanism that destroys savings does not begin with a crisis. It begins with a victory. Every time a country emerges from a period of conflict or extreme tension, there is a window in which everything seems stable. Markets breathe. The government announces that the situation is under control. People begin to trust institutions again. And it is exactly in this window that the most silent process of wealth transfer in history begins to operate. Wars cost money, much more than any country can raise through taxes in the short term. The solution found by governments over the centuries is always the same: issue debt and, when necessary, expand the monetary base. In plain language, print money, not literally, as in the past, but through modern mechanisms with the same practical effect. More dollars circulating in the system, each dollar worth less than it was before. The problem is not that this happens. The problem is that it happens slowly. Slowly enough that most people do not notice while it is happening. Those who keep dollars in checking accounts, in savings, in long-term bonds see the nominal balance remain the same. The number does not change. But what that number can buy keeps decreasing. A family that had $100,000 saved in 2001 reached 2008 with the same nominal $100,000 and significantly less real purchasing power, without losing a single cent on the statement, without having done anything wrong, simply by trusting the system exactly as the system asks to be trusted. The loss happened within the rules, within what was considered prudent, responsible, and correct. This type of silent loss does not appear in any official statement. Meanwhile, gold was moving in the opposite direction. Between 2001 and 2008, the price of gold went from approximately $270 per ounce to nearly $1,000. Those who held physical gold during that period saw the asset do exactly what it has always done when currency loses strength: preserve purchasing power. Gold does not generate income. It does not pay dividends. It does not have quarterly earnings. What it does is one thing only, but it does it with impressive historical consistency: maintain real value over time, regardless of government decisions about currency. Now observe what is happening in 2026. The United States carries a level of public debt without precedent in peacetime. The Federal Reserve has spent years alternating between tightening and loosening monetary policy, trying to balance inflation and growth in a scenario that offers no good outcomes for both simultaneously. Active geopolitical conflicts in multiple regions put pressure on supply chains, energy prices, and the cost of virtually everything. And the dollar, for now, still functions as a safe haven, attracting capital and, in the process, pushing gold down. The current drop in gold is not a sign that the metal has lost relevance. It is the expected behavior in this specific phase of the cycle. Capital migrates to the dollar. Gold falls. It seems like the system is strong, and then, sooner or later, the bill comes due. The question no one can answer precisely is, when? No analyst, no economic model can say exactly when the cycle turns. What history allows us to state based on solid evidence is that it turns. It always has. And those who were positioned before the turn were the ones who captured the greatest gains. There is also a layer that few people mention directly: silver. Historically, silver moves with gold, but with much greater intensity in both directions. It falls more during the downward phase. It rises more when the cycle reverses. This makes silver an asset with a different profile, more volatile, but with proportionally greater potential during periods of recovery in metals. It is not for every investor profile, but it is a concrete fact for those evaluating how to position themselves at this moment. What remains so far is a clear picture. The world is once again at an inflection point. Accumulated debt, pressured currency, rising geopolitical tension, and a metal that has just recorded its worst week in years. Exactly as happened before each of the major historical surges in gold. There is a number that few analysts openly mention because it changes the way people see the entire financial system. The historical relationship between total U.S. public debt and the price of gold. Every time this debt has grown rapidly, as it did after World War II, as it did in the 2000s, as it is happening now, gold, within a period of 2 to 5 years, adjusted to reflect this imbalance. Not in a linear way, not in a predictable week-to-week pattern, but consistently enough to show up in every cycle recorded in modern history. U.S. debt surpassed $36 trillion in 2025. The pace of growth of this debt today is higher than at any other time in the country's history outside of a declared war. This is not alarmism. It is public data, available on the U.S. Treasury website, updated daily. Now comes the part that truly surprises. When gold rises in response to monetary deterioration, it does not rise alone. There is an asset that historically moves before gold and usually signals that the turning point is near. That asset is gold mining companies. The stocks of companies that extract gold tend to price in the movement of the metal in advance because their profits expand disproportionately when the price rises. A miner with a fixed cost of $1,200 per ounce selling at $1,800 has a completely different margin if the price goes to $2,500. The metal doubles. The company's profit can triple. This leverage effect makes mining companies one of the most studied assets by those who follow metal cycles for decades. But there is a twist in this analysis that few expect. Gold mining companies have had historically weak performance in recent years, even during periods when gold itself appreciated. The reason is technical. Operating costs rose along with inflation. More expensive energy, more expensive labor, more expensive equipment. The result was that, even with gold rising, miners' margins did not expand in the expected proportion, and the stocks lagged far behind. What does this mean now? That if gold continues to rise and costs stabilize, which is beginning to happen in some segments of the sector, mining companies may represent the most aggressive recovery of the entire cycle. Not because the sector improved, but because it fell far behind. This is the kind of asymmetry that appears rarely, and when it appears, it does not remain available for long. Returning to physical gold. This week's drop needs to be read within a broader context. When the dollar strengthens, investors around the world need more dollars to buy the same ounce, which reduces short-term demand and pushes the price down. This mechanism is mechanical, predictable, and temporary. What is not temporary is the structural reason why gold exists as a store of value. The inability of governments to resist monetary expansion when they are under pressure. This trend has not diminished. Based on available data, it has increased. There is also a factor that has entered the scene in recent years and partially changes the dynamics of the market. The massive purchase of physical gold by central banks in emerging countries. China, India, Turkey, and Poland have been adding gold to their reserves at an accelerated pace. They are not buying ETFs. They are buying physical metal and removing it from the market. When the structural demand from central banks combines with the expected devaluation of fiat currencies, gold does not need a dramatic trigger to rise. It only needs time to pass. The worst week in years may, in practice, be the last opportunity to enter at a price that, in 2 or 3 years, will seem incomprehensibly cheap. This statement is not a promise of returns. It is a reading of a pattern that has repeated 3 times in the last century, and that today presents more accumulated fuel than in any previous episode. The question that remains is no longer whether gold will rise. The question is another, and it will be answered in the next section. The question left open in the previous section is not about price. It is about behavior. What should you do when the asset considered the safest in the world falls precisely in the week when the world seems most unstable? The intuitive answer is to sell. Reduce exposure. Wait for the situation to become completely clear. And that is exactly the response that repeatedly throughout history, has separated those who preserved wealth from those who lost it. Gold is not an asset for those who need quick returns. It never has been. Those who bought gold expecting to profit in weeks are usually disappointed. The metal functions as long-term insurance against time, against the slow erosion that governments impose on the purchasing power of their currencies over the years. Insurance does not generate excitement. It generates protection. And protection has a price that is only understood afterward. The 3 decades between 1970 and 2000 were the longest period of weak gold performance in modern history. The metal remained stagnant while stocks and bonds surged. Those who held gold looked at other assets and felt like they were on the wrong side. After 2000, gold multiplied its value more than 7 times in 12 years. Those who waited for clarity missed most of the move. This pattern repeats because human nature does not change. We buy what has risen. We sell what has fallen. And the market transfers wealth from those who act on emotion to those who act on analysis. The most important lesson that the history of gold teaches is not about gold. It is about timing. Wealth is not lost in crises. Wealth is lost slowly in the quiet years that follow, when the cost of accumulated debt is paid through the silent destruction of the currency's purchasing power. The crisis is the visible event. The real loss is the invisible process that follows it. Those who understood this in 1920 remained calm while Europe inflated its economies. Those who understood it in 2002 bought gold when it was still below $400. Those who understand it now are looking at a week of decline not as an alarm, but as a window. There are 4 assets that have historically survived cycles of monetary destruction. Physical gold, outside the banking system. Silver, with its more volatile profile and greater relative upside potential. Productive land, which generates real income independent of currency. And short-term liquidity positions indexed to inflation, which preserve the ability to act when opportunities arise. What has not survived these cycles is also well documented. Long-term bonds and fiat currency, nominal savings without inflation protection, and any asset whose value depends on a government's promise to honor its debt in real terms. This is not a pessimistic view of the world. It is a realistic view of incentives. Indebted governments have an incentive to inflate. Pressured central banks have an incentive to expand the monetary base. This is not a conspiracy. It is the path of least political resistance, chosen repeatedly on every continent throughout the past century. Gold does not rise because someone decides it is worth more. Gold rises because the dollar and all other currencies are worth less. It is a reflection, and reflections do not lie. The worst week in years has ended. The price is under pressure. The news is full of analyses explaining why gold has lost strength. And it is exactly here, in this moment of negative consensus, that history says to pay attention. Not because history guarantees repetition, but because the fundamentals that produced every major gold surge in the past century are present today with an intensity that has no recent parallel. Record debt, structural monetary expansion, persistent geopolitical tension, and growing physical demand from central banks that have quietly decided to reduce their dependence on the dollar. If you made it this far, you already have more clarity about this market than most people who will be making financial decisions in the coming weeks. Use this knowledge carefully, consult a professional before making any moves, and don't forget to subscribe to the channel, like the video, and tell us in the comments which city or country you're watching from.